I'm about to show you exactly how you can have $126,000 of income in 2025 completely tax-free. And this isn't some sort of secret or nefarious act to evade taxes. This is an opportunity hidden in plain sight, but most people simply don't know what to look for. Hi, my name is Jacob Duke, and as the owner of a retirement planning firm, I help people just like you create tax-efficient retirement plans using different strategies. But today I wanted to talk about tax gain harvesting. So in this video, I'm going to explain what tax gain harvesting is, how it works, and show you how you can use this strategy to have $126,000 of tax-free income in 2025. All right, what is tax gain harvesting? In its simplest form, it's the strategic selling of appreciated assets in a taxable account to take advantage of lower tax rates. So you're trying to intentionally sell an asset that has gone up in value at a specific tax rate. So this is the opposite of tax loss harvesting, which is something maybe you've heard of before, where you intentionally sell a loss in a brokerage account to offset other income or other gains that you might have elsewhere in your portfolio. So you have tax loss harvesting on one side, which is probably the most common of these two different strategies. And on the other side, you've got tax gain harvesting, which in my opinion is probably the most beneficial of these two and could be used in many different ways throughout your retirement. So that's what tax gain harvesting is. You are intentionally selling an appreciated holding within a brokerage account to make sure that you can do that at a lower tax rate compared to what you might pay in the future. Now, what are some things that you've got to do to make this even possible for yourself? Well, number one, you have to have a brokerage account because that's where all this takes place. You have to have a taxable account. This cannot happen in an IRA or a Roth IRA or a 401k because it doesn't matter how often you trade within those account types. No taxes are generated based on those trades. Those accounts are what's called tax sheltered, meaning no taxes are paid annually. The only time you pay taxes on an IRA or a 401k or a Roth IRA for that matter is going to be whenever you distribute money out of those accounts. And if you take money from a tax deferred IRA or a tax deferred 401k, every time you take money out, that's going to be taxed as normal income. There's no long-term capital gain treatment on those specific account types. So while those accounts have advantages to being tax sheltered, meaning they're not paying taxes annually, a brokerage account has advantages around how the gains are actually taxed whenever you sell investments within the account. Yes, with the brokerage account, you're going to pay taxes every single year on dividends or interest or realized capital gains as we're talking about here, but you can use this account in a strategic way to align your income with your lower tax years to where you can strategically sell investments or holdings within your brokerage account that have increased in years in which you have low income that allow you to pay 0% on those long-term capital gains. So how does this work? Right here you can see on the screen the long-term capital gain brackets. Now you can see this for married filing jointly and for single people, and in 2025, the 0% long-term capital gain rate bracket tops out at $96,700 for folks who married filing jointly, and then $48,350, exactly half of that for single people. So you'll have to apply this based on your situation and your marital status. But what you can see here is you can realize that much of a long-term capital gain and pay zero taxes on that much of those gains. So let's go through an example together to help this make more sense. We can see we've got here an example couple, and we're going to be doing this married filing jointly rather than for single folks. So I'll do a separate video later for single folks if you want to see that. And if you do want to see that, let me know down in the comments below. But what I wanted to show you here is let's assume a few things. Let's assume in terms of their income that they have no earned income, meaning they are retired. So we're going to assume that they're retired. They're also not taking any money out of their IRAs at this point. They also have not turned on their Social Security. They don't have any rental income. So they have no other sources of income. They have zero income, which I'll admit is fairly hard to do for most people. But let's assume that that's the case in this scenario, just to kind of give you an example of what this looks like and how tax gain harvesting works. So they've got no income at all. Now let's look at their overall accounts. They have three different account types. They have IRAs combined of about $1 million total between them two. They also have Roth IRAs of about $100,000 combined between the two. And they have a brokerage account, which is what we're going to focus on here, of $350,000. So those three different account types, they've got just under $1.5 million total assets for retirement. That's their account breakdown. Now let's look at their brokerage account specifically. Let's kind of assume a few things about this. Let's assume that they bought the investments within that brokerage account. The total cost basis was about $175,000. So they put $175,000 of their money into the brokerage account originally, and that has now grown to $350,000. So it has doubled in value over however long this has been. Now, one other thing we need to assume here to help make this example work is we need to assume that they have long-term capital gains on that $175,000 of growth. Now, what does that mean? What is a long-term capital gain? Well, you can see here on the IRS website that a long-term capital gain is whenever you hold an investment for longer than 1 year, it now can receive a long-term capital gain treatment. So if you hold a piece of real estate for longer than 1 year, you can then sell that real estate later down the road after that 1 year time frame is passed and have a long-term capital gain treatment. Same thing for your stocks or your mutual funds or your ETFs within your brokerage account. The taxable brokerage account, you can receive long-term capital gains. If you sell your investments before that 365 days, you will have a short-term capital gain, and a short-term capital gain is taxed just like normal income. So there's no benefit to having a short-term capital gain as it pertains to taxes. So whenever we're doing this tax gain harvesting strategy, we have to have long-term capital gains. So let's assume that they've held this for 10 years, okay? So 10 years is how long they've held it, and it's doubled in value. So they want to have $126,000 here in 2025 of total income. So how are they going to make this possible? Well, if we look back at what the standard deduction is, we can see in 2025 for married filing jointly, it is $30,000. So that's what we have to work with. And also, if we look back at the long-term capital gains brackets, right above those brackets, it says that that is based on the taxable income, not your adjusted gross income or your modified adjusted gross income. So what does this mean? This means whatever your total taxable income is after you've deducted out your standard deduction. So if we get to the total amount of income that someone could have and still pay no tax on their long-term capital gains, we have to add that standard deduction back in. So what does that mean? Well, the first $96,000, as you can again see there, that is 0% taxable. So 0% tax rate on those $96,000 of capital gains. But also we have a $30,000 standard deduction. And if we add that together, that equals the 126. So the AGI can be 126. That's how much you can have and still pay no tax on a long-term capital gain. So again, they have no other income, right? So there's nothing to add into this other than what they would want to realize in their brokerage account. So they've got $175,000 of total gains in the account. The current value is $350,000, which means that 50% of every dollar in the account is capital gains and the other 50% is their original investment. So let's back into how they need to construct their distribution, how they need to construct how they sell and realize gains within their account to reach that $126,000 threshold. Okay, so if they've got $126,000 is how much they can have of capital gains, they need to double that. If 50% is the amount of growth that's happened, they need to double that. So that would be $252,000. Sorry, I'll use this one. $252,000. Okay, that's how much they can sell within their brokerage account, assuming that the average across all of those different shares is a 100% growth rate, meaning half is gains, half is principal. So $252,000 is double this amount here. That's how much they can sell in their brokerage account and still pay no taxes on the gains. So of that 252, again, 126 is gains. And then 126 is cost basis, their original investment. So we take the 126 that they have realized, that's how much gains they've realized. If we subtract out the standard deduction of $30,000, we're left with $96,000. And again, as you can see here on the screen, $96,000 is less than the top of that 0% capital gain bracket for married filing jointly, which means none of this is taxable. In fact, none of this is taxable. So what have they just done? They've created $252,000 of income coming to them out of their brokerage account, and they're paying no tax on any of it. So, Jacob, what if they don't need $252,000? Well, that means they can take the other $126,000 they don't need. They can invest that back into the brokerage account, and essentially they've reset their cost basis. They've increased their basis so that their future gains are not going to be as high. And also, too, if they want to hold that other $126,000 in cash for next year's income that they might need in retirement, they can hold that in cash. And again, they're going to pay no tax next year, which means they could do some sort of Roth conversion strategy on their IRAs or something like that. So they created 2 years worth of income. If they need $126,000 this year to live on, they created 2 years worth of income in 1 year and paid no tax on any of it. So that's the key here. Now, what I want to do is I want to take this situation and add in a different variable. I want to make an IRA distribution out of their $1 million of IRAs. So what happens if they have $20,000 of an IRA distribution? How does that affect how much they can sell and realize within the brokerage account? So they've got $20,000 there. And remember, $126,000 is the total gross income amount that we can have and pay no taxes on the long-term capital gain. So if we've got $126,000 of room, that's what that's showing. We have also an IRA distribution of $20,000. We have $106,000 of room left. So what does that mean? That means that they can sell 2 times that amount. Remember, their investments in their brokerage account have doubled, so they can sell twice as much, and only half of what they sell is gains. So that would be $212,000. They can sell $212,000 within their brokerage account, which again holds $350,000. They can sell $212,000 of that and pay no tax on their capital gains. So again, we can see instead of 252, now they can only sell 212, but still they're not going to pay any tax on those gains. So what you can do as you're evaluating your situation, you can start to add in your different sources of income and see how much room you have between your total income from IRAs or Social Security based on how that's calculated, which I've done other videos on that. So if you want to learn how Social Security is calculated, you can check those videos out. I'll have them linked down in the description below for you. Once you add in all these different sources of income, you can see how much room you have to realize capital gains and do this tax gain harvesting strategy to where you pay 0% on your long-term gains. So let me know in the comments, was this video helpful? Do you want to see more videos like this or different case studies? If you do, let me know your situation, your different sources of income. I want to make these more applicable to you specifically. So let me know in the comments, and we will see you next time.